Thank you everyone for joining us. Welcome to our Crux's webinar discussing emerging deal terms and structures in the tax equity and transferability market. Crux has been honored to coordinate with Jeff Davis and Hayden Baker at White & Case on this topic. And thank you to everyone who's taken time out of your day to join us. A recording of this webinar will be available later this week and linked on the Crux website. We have received an enormous amount of interest from folks in today's topic, and we have our Q&A feature open throughout this discussion for those who may be interested in asking questions. To preview, we will do our best to address those questions today, but I would also encourage you to direct any questions that you may have to the White & Case team, to Corey at Aon, or to us at partnerships@cruxclimate.com to receive a more fulsome answer. And before we begin, allow me to introduce our panelists today. We are joined with Hayden Baker, a partner in White & Case's Global Mergers and Acquisitions Practice Group, working on mergers and acquisitions, energy and infrastructure projects, and financing transactions. Jeff Davis is a partner in White & Case's tax practice, advising clients on a wide range of U.S. federal income tax matters with an emphasis on project finance, development, and renewable energy transactions. We are also pleased to be joined today by Timmi Kloster, a syndications officer with U.S. Bank's Impact Finance practice. She has spent 9 years working in syndications of tax credits with the bank. We are pleased to welcome back Corey Lewis, a managing director with Aon's tax practice and a leader in issuing tax insurance, covering a range of transactions in clean energy tax credits. And finally, my colleague James Turnbull, a transactions principal here at Crux, joined us in January from Commonwealth Bank, where he spent over a decade working in the banking sector. With Commonwealth, James supported some of the first transactions structured around transferable tax credits. Thank you all for joining us today. To kick off our discussion, I am going to direct my first question to the folks that we were so pleased to partner with, Hayden and Jeff with the White & Case team. So Hayden, Jeff, let's start with the basics. Most folks on our call today are familiar with the tax equity partnership flip model. But what about this new hybrid T-flip model? What are those? How do they differ from the precedent T-flip structures?
Necessary as a financing structure for renewable energy projects, but the direct transfers have a number of shortcomings. One of those is that they don't generate a step up in basis, which is a key value driver for ITC deals in particular. And they also don't monetize the depreciation. So, as a result, the partnership flip still plays an important role. But as your question suggests, it's been enhanced, it's been changed to adapt for the transfer feature. So as a result, what we're seeing now is partnership flips where the partnership will transfer out the ITCs. And that's sometimes been called a transfer out. Sometimes it's been called a hybrid structure. And we've also seen it, and perhaps this is becoming the most common title, a T-flip. Now, with the T-flip, we're seeing at least initially a couple main variations of that. The first is a deal where you have a traditional tax equity investor. So, think of the banks that have for a long time been staples of the tax credit industry. They'll make the investment in this partnership, but then they'll cause the partnership to sell a portion of the tax credits that would otherwise be allocable to that bank. Now, that sale may be done for a number of reasons. Perhaps that investor wants to accelerate distributions by converting some of those tax credits to cash via that sale. It may also be that investor wants to reduce the tax credits that it's going to claim because it needs to match its allocation to its tax appetite. So essentially trying to manage its tax base so it can invest in more projects, something we saw even with traditional tax equity deals. Or it may need to manage its exposure to a sponsor, a geographic area, or type of project. Again, something that we saw with traditional tax equity deals. So that's the one variation where, you know, traditional tax equity investor invest, and then, you know, they're causing that transfer out from the tax equity partnership. The other is a similar deal, except instead of having a traditional tax equity investor that has the tax appetite, you may have a fund investor or some other type of investor that doesn't really have as much tax appetite in the first place. And it similarly would cause the partnership to sell the tax credits. The big difference being that it's probably going to be selling most or all of the tax credits as opposed to just some portion of those, and you know, keeping some skin in the game. Now, with both of these types of structures, you know, you've got a tax equity investor at the table that is going to allow the project to achieve a step up, and also allow monetization of the depreciation. But in addition, this now introduces an additional stream of cash flow. So, you know, not simply a reduction in tax liability for that investor, but actual cash that's coming from the purchaser of the tax credit that can be used to collateralize debt. So that's another, you know, feature that structurally can allow greater flexibility. Now, you know, I also mentioned, you know, I said, you know, there were a couple of those key shortcomings of transferability, but one of the key benefits for ITC deals is if you've got a transfer deal, that buyer of tax credits doesn't have to take construction risk. And in fact, that buyer doesn't have to take much risk at all in terms of project risk. And that's because they don't have to own an interest in the project like you do with a partnership flip in the investor there. Now, that's not to say they don't have any risk, because there's still recapture risk, which I'm sure we'll talk about more later. There's a lot to unpack there, but I'll pause there and let others chime in.
I'll jump in here too, Katie, and thanks for hosting us. I know your question's really about T-flips, but I also want to underscore and maybe set up for later in the discussion sort of another structure that's come into the market as well. So just like traditional partnership flips now have a feature of transferability, developers relying on transferability may also want to use a partnership to optimize the step up in depreciation that's otherwise sort of lacking. So this is out there as well. This is where a developer takes on a pref equity investor to create that partnership, obtain the step up. And so, you know, as we go through the discussion, I think it's important to think about that form of pref equity investor as a creation of a partnership in connection with tax credit transfers. And just one other thought before on this notion of sort of the Class A investors who are coming in who may not have the full tax appetite themselves. You know, they're making a market. They're expanding the market, you know, rather dramatically for tax credit investors to come in, which is great. But they're also taking on a risk, and one way to sort of think about that risk is really like an off-taker risk. Really, the off-taker for the buyers of those tax credits. And so I think that's helpful as you think about what terms they're solving for, to think about that risk that they've taken on.
Yeah, thank you both. That's super helpful. And I think the point about taking on an investor for the purpose of achieving a step up in basis is something that we also, you know, need to prioritize in this discussion. There's a lot of material to unpack, but one of the points that I think, you know, that Jeff and Hayden have made particularly well is kind of talking about who the investors are in this space. And you've got your sort of legacy investor category, of which, of course, you know, Timmi is a part, but then you've also got new entrants to the space and maybe even some overlap between those two groups. And so I think one important lesson potentially for developers who've joined the call today to think about would be, how should they be thinking about these different types of investors, whether it is in the partnership T-flip structure, whether it is in a more of a minority JV kind of investment. How should a developer be, and we'll also speak about the investor side, but how should developers be thinking about these groups? And I mean, that question is back to the team at White and Case, but it's also, to anyone else who wants to answer it.
Sure. Yeah. So, in addition to the investors in the partnership, which include, the two broad categories that I already mentioned, your traditional tax equity investors like, US Bank and, Timmi's team there, and, the funds, think, private equity funds, other, sorts of investors like that are looking for opportunistic investments where, they can, add value and generate some cash flow. You've got, a whole nother set of people that are coming to the table in the role of tax credit purchasers. And as I mentioned a minute ago, those tax credit purchasers, in the case of an ITC deal, for example, don't have to take construction risk. And for the most part, those ITC purchasers are largely insulated from project risk. That's because unlike a tax equity investor where you've got to own an interest in the partnership that owns the project in order to be able to get the tax credit, if you're a tax credit purchaser, you don't have to have that ownership interest. So as a result, we're seeing a whole bunch of corporates that may not have the underwriting teams so they can really understand the project risk. They may not be interested in owning a renewable energy generation asset, but maybe they want they've got mandates to go green, so they may be interested in buying the tax credits. So we're seeing a lot of corporates that historically have been on the sidelines stepping into the space. And in many cases, those corporates are not only buying the tax credits, but they may be also signing up as off-takers under virtual PPAs. They may also be buying the RECs or the EACs, the energy attribute certificates from the project. So, in many cases, what we're seeing is corporates that may have historically had virtual PPAs and that were buying the RECs now stepping in to actually buy the tax credits. So, there's a whole universe of potential investors out there that are emerging, and it's creating a new source of cash flow to the projects that can be leveraged with debt.
Yeah, I mean, Timmi, I want to turn to you now and just kind of get your perspective as someone who's in the seat of an investor and syndicator. What are the evolutions that you as a lender, but then again, also as a syndicator, are seeing that take advantage of the additional flexibility afforded by the Inflation Reduction Act?
Yeah, thanks, Katie, and thanks again for the invitation to join you all today. I would echo a lot of what Jeff and Hayden have shared so far, but maybe just to add a little bit more color from the syndication seat. I think the flexibility, the biggest piece of flexibility that we're seeing is time. We now have time to bring investors into these, whether it's a partnership, as we historically have had to do it. Now we have the ability to transfer the credits up until the extended tax return filing date of the year following placed in service. So we've now created a runway to allow for these projects to, be built, have tax equity committed. We're using the hybrid structure, the T-flip structure at US Bank. That's our primary way of doing these structures that the folks at White and Case touched on. So we now have the luxury of time, which in the past, for any folks that have tried to bring a third-party investor into this space, how challenging it can be, and to add a time crunch onto all of that is a double challenge. We're also seeing, again, some of the efficiencies with not having to form partnerships. The accounting has been simplified. The tax partnership analysis, not having to be an owner of the project. These were all hurdles that investors historically had to get comfortable with, that we now can sort of streamline and sort of take off the table. So that is bringing a huge influx of new investors into the space. So we have more time. We have a larger pool of investors to work with. we're seeing simplified documentation and diligence. Our checklist has gotten smaller in terms of with our investor base, what we're sharing from a diligence perspective, what pieces of documentation we need to put in place. We have a very short sort of list of transfer documentation. There's really the transfer agreement is the main document there. So helping streamline that part of the process has really helped our platform evolve and become, I think over time more efficient. I think not to say last year didn't have its challenges and as the platform was developed, but that certainly I think over time we're going to continue to see more streamlined documentations. The other thing we're seeing evolve is with the IRA, there's now more tax credits that folks can invest in. There's longer extensions on these tax credits, unlike we've ever seen before. So having this longer runway, we're seeing investors now make multi-year commitments. We're primarily in the ITC space with our own investments. And so now having conversations 1, 2, 3 years out is something that historically we just haven't sort of even been able to contemplate with our traditional partnership structures. So that's been evolving as well. And that gives us the ability to go out and commit more because we have investors committed at the table further out. And then also deals are just getting larger, I'd say, with adders. And also just, cost efficiencies with equipment and the way these projects are getting built. And so what we're seeing in the market is even first-time investors who haven't even done tax equity before, they are able to make huge commitments like right out of the gate that, historically doing a traditional partnership, it was always, well, let's get one done and see how it goes because they wanted to get that comfort level before they sort of dove all in. But because these structures are more de-risked, as we've started to touch on, I think we're seeing larger commitments, even for folks who are new to the space.
Yeah, thank you.
I'll just note that.
Yeah, please.
One thing I would note with respect to something Timmi said about the runway is, historically we had tax credits that would expire and then get extended, or they'd almost expire and then get extended. So there were a lot of investors, or potential investors, I should say, that were interested in the space, but they just weren't willing to make the commitment to, build a team, to study the market, to understand how the deals are done, because, as soon as they got everything ramped up and ready to go, the credits would expire and they couldn't do any deals. So, we're now seeing companies that are willing to deploy resources towards, transferability and for that matter, tax equity investors more broadly, because they now know there is that long runway and it's not just going to be a 1-year thing where, okay, you do a couple deals and then the credits go away. So that's been huge, I think, in terms of inviting new participants, which is also, as Timmi pointed out, really important given that we now have so many more tax credits. We need those additional investors to help take those up.
Yeah, and Timmi, we got a question that I think is a good one to kind of go back to, which is to expand a bit on your comment about the luxury of time and how, from a timing perspective, the IRA provisions are different from how the historical use of these tax credits operated.
Sure. Yeah, so I'll stick with in the ITC context. Historically, there are rules, at-risk rules that you need to, in order to be, you had to form partnerships with the solar developer, for example, in order to be allocated these tax credits. And there are tax rules that say you have to be sort of in the project as a partner before the project is placed in service so that you have skin in the game. You're at risk with the, the construction risk of these projects. So that would require having a tax equity investor lined up. And sometimes, we have a very short window for closing when a project is brought to us by a developer, 6 to 8 weeks from when we start underwriting until the point of when we might start, flipping some switches at the project level and start putting power on the grid, where you start to get in sort of that gray area of not being able to bring a partner into the structure after that point. So that 6 to 8 week window, and sometimes there's a little bit more time than that, but that's maybe on the more extreme end of the scale. You can see how that would create a lot of challenges. We would refer to them as simultaneous closings, essentially, with our third-party investors, where they're basically at the underwriting table with us and looking at, because they're in these partnerships, having to get comfortable with a lot of the underlying diligence. And that can slow things down. It can be challenging for the sponsors. So we're now no longer having to operate in that regime. US Bank can still forward commit. We're still doing the underwriting and going through the process of forming these partnerships with our developer, but we're building in those mechanics into those tax equity documents that Jeff had touched on earlier, so that we have the flexibility down the road to transfer the credits out. So we don't need to have a purchaser signed up before the project's placed in service and online. We can rely on our expertise and what we're seeing in the market to know we can bring a buyer in after the fact. And the IRA rules do allow for a transfer election to be done all the way up until the year following place in service, that extended tax return deadline for the partnership, because the partnership is ultimately the entity that has to transfer those credits. So you've just built in, depending on when you place the project in service, 12 to 18 months, potentially more time to sell those credits to a third-party investor. So hopefully that sheds some more light on the luxury of time.
Yeah, that's excellent. It's very, very helpful. And it makes, as you said, just a huge difference. So I want to turn, if we could now, to Corey. And Corey, when we talk about the buyer side, you're really there as the buyer is looking at the credits and exploring the risks that they're taking on in the course of pursuing a transaction. And I think Timmi and Jeff and Hayden have all mentioned that a lot of these buyers are new to this space. So what are some of the important insurance provisions that buyers are thinking about when they approach a transaction? And I'll ask you, just as a preview, I will ask you a more specific question around PTC, so you don't necessarily have to explain all of it, because I know there is so much, but I'd love to get kind of an overview from you of those risks that come up in the insurance process.
Yeah, sure. Katie. So I would say, from my perspective and where I sit, I would say it's a 50-50 split between whether it's the seller who's the insured under the policy or the buyer who is the insured under the policy. That's very much a commercial negotiation between the parties. From the insurer's perspective, they're pretty flexible. Just depends upon sort of specific preferences of the parties involved in the transaction. Big picture, what I'm seeing in real time is that when the buyer of the credit says jump, everyone else says how high, and that includes exactly what specific risk or risks folks are looking to insure. For the most part, where I'm seeing things settle in real time, and again, if we have this conversation a week or two and now my answer might change, but where we are right now is the buyers of the credits want full wrap tax credit insurance. So whereas before, pre-IRA, probably the most common policy we place insured just that the amount of the qualified basis or fair market value will be respected. Think of that as the appraisal risk, or that the allocation between what is ITC eligible or not ITC eligible will be respected. Think of that as the cost segregation report risk. I'm now being asked to insure structure, qualification, and recapture risks. And this should be a good time to point out how wrong I was, because as Jeff kind of hinted at, when the IRA was announced and we heard transferability, I thought I would never insure a structural tax risk or issue again. And instead, look at this, we're insuring it more now than we ever were before, ensuring that the partnership's a good partnership, that the allocations of credits will be respected, that the partnership will be treated as the owner of the project. And a lot of that's being driven by tax credit buyers who, they have some familiarity with their space, but maybe not necessarily as much as the sort of typical run-of-the-mill tax equity investors. So they're looking for that additional comfort. And then especially internally, as they're getting sign-off from their internal C-suite on making these quite large tax credit purchases, it's very helpful for them to be able to point to tax credit insurance and say, hey, we've got an insurance product that will make us whole in the event of there being any issues or concerns, whether the structure will be respected, whether the project in fact qualifies for the credit, or if there's been any recapture under Section 50. So for the most part, that's typically what we're seeing. And from a limited liability perspective, again, there's complete flexibility. There's absolutely no requirement. But what we're seeing folks typically sort of settle is around 100% to 125% of the amount of the ITC, taking into account that the items of loss under a tax credit insurance policy are not just any additional taxes, which you can think of as loss credits, but also any potential interest, possible penalties, those contest costs or legal fees in the event of an audit, and then all of that subject to a gross up. So if the insurance proceeds themselves are deemed to be taxable, the insurance policy would pay any taxes on the proceeds themselves.
And then Corey, if you could we've got a couple of questions clarifying the term full wrap insurance. I think if you're familiar with an EPC full wrap, this would obviously be different from that. So when you think of a full wrap insurance on a transaction, what generally does that include?
Yeah, what I mean specifically and only from a tax credit insurance perspective is really insuring those three buckets of risk that I hinted at: structure, qualification, or recapture. Tax insurance itself and tax credit insurance specifically heavily customizable. There's no requirement that you move forward one certain way. You can pick and choose exactly what risk or risks you want to insure. As I hinted at, the most common policy in place insure just those qualified basis risks. We can do qualification and structure. We can do structure and recapture. We can do all three. But where I'm seeing things settle down in real time is an increased demand for, when I say full wrap, ensuring structure, qualification, and recapture in a single tax insurance policy.
Thank you. And so this is really kind of a question to everyone, but sort of zooming out, you've got new buyers into this space. There's an insurance product available to sort of indemnify them against a variety of risks. But when you think about sort of the traditional risks in project finance, operations is obviously one of those risks that an investor is aware of. And with a PTC project or a PTC transaction, you still do have some operations risk and I know, Timmi, for you all, you're very focused on ITC, but be interested to hear how folks are thinking about operating risk around PTC transactions, and how from, Jeff and Hayden, how are your clients sort of looking at that? And then Corey, is there any way for a buyer to really forward purchase PTCs and insure against a project, maybe not, or a manufacturer for that matter, not necessarily achieving the target run rate of PTCs?
Yeah, so a couple thoughts on that. I mean, first of all, it is possible to get a forward commitment for PTCs or for other types of tax credits that are like production tax credits. So think, for example, the 45X manufacturing tax credits that are based on production and sales of equipment. With respect to any of those types of credits, there is some risk that the production doesn't occur, the manufacturing doesn't occur, or the equipment's not eligible, or the sale doesn't occur. There are a lot of risk that may be introduced to that. But what we've typically seen is the credits aren't paid for until after they've been generated. So that tax credit purchaser might have the forward commitment, and the seller would have an obligation or would agree to deliver some minimum level of credits. And if they don't meet that, then there could be damages or something along those lines. But at least from the purchaser's perspective, it's a little different than paying for a whole bunch of credits up front, where you think of traditional partnership flips where not more than 25% of your consideration could be contingent. Well, here you're essentially, changing the rules. You don't have to put up 75% of your money essentially up front, but it's basically just a pay-go deal. The entire thing is a pay-go deal. So it has a very different risk profile from the investor's perspective. But obviously, if they're counting on, or I'm sorry, from the buyer's perspective, but if they're counting on getting those credits, then it can be disruptive if the credits aren't there. And for that, that's the reason that there may be damages or, the possibility of sourcing credits from some other source.
Yeah, I agree with
one thing.
Go ahead, Corey.
I was just going to say, sorry, Timmi. I'd say from a tax insurance perspective, the tax insurance markets aren't going to necessarily insure whether the sun will shine or the wind will blow. There may be other types of insurance solutions out there that could potentially be a solar type put or something to that effect. But what we do see on the PTC side, if there's any question, especially with like a 45X as an example, if there's any question around whether something qualifies for the credit, that's more of a legal conclusion type risk in nature. That's something where tax credit insurance can be of assistance. And what we're especially seeing a lot of activity on, especially on the PTC side, are any or all of the adders, whether it's an energy community adder, domestic constant adder, or even low income community adder. Those are other instances where tax credit insurance may make sense. Apologies, Timmi, go ahead.
No, I was just going to echo. I agree with a lot of what Jeff shared with the sort of pay as you go basis helps minimize, some of those challenges with the fluctuation or potential fluctuation in production. And just to say too, with the PTC not having being subject to recapture, that sort of, I think, is appealing to some of the buyer market where, again, they are looking for a de-risked product and they want to have the comfort that, there's, once they've paid for this credit and they know what the amount is, that they're not sort of subject to the recapture risk that they see with the ITC. So that is some of the appeal going the PTC route as well.
Yeah, thank you all. And those are really important questions. Kind of turning to James, we wanted to touch a bit on market liquidity and that sort of that buyer pool and what creates that buyer pool. And I think these are all really important observations from that perspective as well, because the simpler and the better protected, simpler a transaction, better protected the buyer is, presumptively the easier it is for buyers to begin to explore the market. But James, I've been lucky enough to be in a bunch of conversations with you with prospective and current lenders in this market, and folks are very focused on understanding how liquid the buyer side of the market really is. So at Crux, we have the opportunity to see lots of different kinds of projects, lots of sizes of transactions. Maybe you could summarize for us a little bit what we are seeing with respect to buyer interest.
Yeah, absolutely, Katie. Thanks. So I would say we are working with buyers from all ends of the market. In terms of size, they range from small family offices with passive income to offset all the way up to Russell 2000 and Fortune 500 companies and their tax advisors. Broadly, I'd say they fall into a few different types of personalities, as Jeff touched on earlier. There's taxpayers that are exploring transferable tax credits for the first time. There's more diversified corporates that have experience with tax credits through state incentives and LIHTC. And there are players that were traditionally familiar with tax equity, financial institutions, energy companies, and the like. And it's probably that last group that have expressed interest, not just in acquiring tax credits, but also exploring some of these more emerging structures like the T-flip to effect a basis step up. In terms of the market for 2023 credits, we're seeing exceptionally strong buyer interest. Right now, buyers are looking for hundreds of millions of dollars in 23 credits, and demand is far outweighing supply there. I think it's fair to say that for transaction efficiency reasons, previously they were focusing on larger credits, thinking maybe 20 to 50 mil range. But given those supply dynamics, there's buyers that are really open to transacting on some of the smaller credits. And so we expect pretty strong liquidity further down the size range. Where we've seen most activity for 2024 credits to date has been in some of the larger ones. Again, 10 to 100 mil, but in particular, the 20 to 50 mil range. But that said, we have seen a few expressions of interest on some very small credits. I mean, at or around the $2 million mark. Even. And I suppose maybe I'd go a bit further on timing. Most of the focus right now is on 2023 and 2024 credits, but there are definitely taxpayers looking ahead to 2025. One of the common sentiments that we hear from buyers is that they're valuing the ability to build a relationship with sellers of credits. And, I think tactically there's definitely value in having definitive docs and diligence material that you can leverage for future credit transfers. Not to mention, of course, building trust between parties. But I think it's interesting hearing that sentiment, because what I read into that is that buyers are really viewing transferable tax credits as an important piece of their tax management strategy going forward, as opposed to a single year's transaction.
I want to, James, because we've had experience with this and we've started to talk a bit about the ways of achieving a step up in basis. And we have a question that's just kind of come in with respect to, sort of valuation methods that buyers are coalescing around. We have certainly, I think, observed that buyers have sometimes some wariness around very large step-ups, but I would love to hear maybe from from kind of everyone in the group, Corey, from an insurance perspective, or is a 70% step up something that you can even insure? What are the standards? And I really use that word so generously because we know that there is not necessarily a standard anything, but what are some of the standards in terms of what folks are willing to stomach to achieve step ups that they feel are fair, and then market those credits effectively to buyers who, for anyone who just is not otherwise aware, the buyer is taking on sort of carrying with them the risk of future recapture if the credit is determined to have been sort of issued in excess of the actual eligible basis for the project. I'm sure I worded that probably worse than anyone else could on this call, but it'll work.
I can maybe speak very quickly from the buyer side. I think, as I mentioned, there's a range of buyers in market, especially some of those financial institutions that have played in this space before. I would say in some cases there is a bias towards technology that they're familiar with. And so some that have experience with the likes of community solar and C&I that are often able to realize these very meaningful step-ups are probably less sensitive to a step up in that range because they've experienced it before and they know that it is justifiable. I would say on the other side of the coin, there is a lot of reliance on the ability to insure against that step up. And so on that note, I'll probably hand over to Corey to speak.
Yeah, I mean, I would just say, so far, we've been very successful at placing insurance on sort of all sorts of types of step ups, including some that are, I think some folks might view as quite high. And in all instances, we're definitely going to need, at a minimum, third-party appraisal from reputable appraisal firm, third-party cost aggregation report from reputable cost aggregation report firm. And the key thing is going to be, why is this step up? Why is this developer profit? Why is this developer margin appropriate for a project of this particular size and in this particular location? Everyone's still very much kind of stuck in the Section 1603 cash grant days where it was 20%, because that's what the Treasury mentioned. I think there's general consensus that that's not necessarily the end all be all. Of course, from the insurer's perspective, they'd love for everything to be 20% or lower, but by virtue of who I am and what I do, that's not necessarily most of what comes across my desk. So it's really just being able to explain and make the argument. And from the insurer's perspective, they're going to take risks on that they think if they will get challenged by the tax authority, that they'll be successful, either within the tax authority and audit or potentially into the court. So giving them the ammo and the positions about why this is appropriate. So far, so good, but I definitely think that that's one of the key things driving a lot of the use of tax credit insurance in the transferability space, honing in on that particular point. There's a reason why that has been, the most common policy that we've placed, over the last 9 or 10 years.
I'll just add, first of all, I agree with what Corey says about, the 1603 guidance and the 20% rule that seem to have been adopted by large swaths of the industry. And just note that, the tax law would say you can get a step up to fair market value if you do it right. So the question is, what is fair market value? And if fair market value is 20% higher than the cost or 100% higher than the cost, it still is possible that it could be defended. So, the question is going to become demonstrating or proving that fair market value. If you've got willing buyer, willing seller that have, truly adverse interest, it becomes a lot easier. And that's why you see the so-called, step up accommodation structures where you have, a preferred equity investor who comes in part to accommodate that step up. But then, you've also got traditional tax equity transactions where there's a third-party investor. But I think, what's important in any of those is, as Corey mentioned, getting an appraisal, but not just an appraisal. You've got to sort of peel back the layers of the onion and see what assumptions does the appraiser use. Are they, just accepting things from the sponsor about cost or, revenue or escalation for energy prices, or are they reaching their own conclusions and coming up with things that are defensible to determine that valuation? So, there's a lot that goes into it, and to simply say, oh, 20% is the limit or 50% is the limit, stop short. You've really got to look at the facts and circumstances to really be able to evaluate that.
Yeah, thank you all. I know that was a really important topic. I'm glad we got to spend a couple of minutes on it. And then just sort of out of respect for everyone's time, I do want to make sure that we end at our scheduled point of 45 minutes after. So I'd like to just sort of close today, and I apologize for everyone whose questions we didn't get to. We didn't actually get to all of my questions either, so hope you don't feel too bad. But the way we thought we'd close out is, of course, we know the market is evolving significantly, and there's more things that we could discuss, and there is time available to discuss them. But if folks have maybe a closing thought to share about what your predictions might be for how this market will continue to evolve through 2024, what is it that you are looking for? And James, I'll pick on you and make you go first.
Yeah, certainly, Katie. And I mean, I think one trend is one that we called out in our market intelligence report, is that on every side of this market, buyers, sellers, even the intermediaries that are facilitating these transactions, there is a real sense that this market is going to be growing and growing quickly. We've seen a lot of positive sentiment, and I think while a lot of players saw 2023 as the year where they sort of dipped their toe in the water of transferability, 2024 is shaping up to be the year when a lot of players really meaningfully start participating in the market. So it's a very exciting place to be.
I'll go next and just say one of the things that I think we're going to see is continued collaboration among different industry participants and for that matter, new players, and people putting their heads together, thinking creatively, coming up with structures, coming up with solutions that are going to move the industry forward and allow there to be new entrants that'll be able to take advantage of the tax credits, but then also, in turn, allow there to be people to buy the now greater supply of tax credits.
I'll echo some of that and sorry, go ahead, Timmi.
I agree with everything that's been shared. I'll maybe just add on that to say, I think the more commercial both sponsors and purchasers can be, they're going to be more desirable to work with. And so that means educating yourselves for first-time purchasers. The more you can educate yourselves on some of the risk in the market and ways we've gotten comfortable in the past, I think that's going to set you up more and more to be able to get the volume that you're looking to achieve. And I would say commit early. If you're thinking about 2025, have those conversations now. We're almost fully committed for our 2024 product and starting to move our conversations to 2025. So I'd say if you want to be in the market long-term, make sure to have those conversations early.
Yeah, I guess I would echo a lot of what you just said. It just, as you're coming in, understand what risk you are taking on, and then make intelligent choices, largely by working with insurer, understanding the other folks that are investing with an aligned interest to figure out how to get either comfortable with those risks or mitigate them or price them accordingly. And that starts by understanding the underlying risk that's there, and then just you don't have to reinvent the wheel. There's a path for mitigating it.
And just from my perspective, I think we're seeing larger credit amounts because of the adders, also just larger projects, and definitely from an insurance perspective, more policies and larger limited liability policies, especially when folks are looking to insure all of those risks, and you're seeing the limits of liability upsized to match that, especially from the new transferability buyers who are looking for that, sleep at night type assurance.
Well, thank you all. That's a little bit past, and so I want to appreciate everyone and the time that you've given us, in particular our speakers. Thank you all so much, and thank you to everyone who joined us this afternoon. I hope everyone has a wonderful week. Thank you again.
Thanks all.
Thanks, everyone.